One of the things I like to ask periodically is if you could only buy one stock, you had a one stock portfolio, what would that stock be? Because that's going to give you an answer. How much risk do you want to take in a single stock? Where do you see upside? Where do you see value? That one stock for me today is Uber. That may sound a little bit surprising. Lyft has actually been one of my favorite stocks here on Asymmetric Investing for quite a while. Lyft's actually done really well over the past year. Uber has now gotten to the point where it's a little bit more of a value. It's a little bit more expensive than Lyft, but it is the market leader. So this is really the biggest aggregation play. And I don't see them losing momentum in mobility or in the delivery business, whether you're looking at food or their move into more hard goods as well, working with a whole bunch of retailers. I think Uber is really, really well positioned and their financials should only get better with time. The asymmetric opportunity with them is with autonomous vehicles. That has been clear. That's why I covered them about a year ago on Asymmetric Investing. I think both of those companies are going to be the point of demand. So let's go through the business, the valuation, why this is the one stock that I would be buying. If you want more from me, check out Asymmetric Investing. There's a link in the screen and a link in the show notes. That's where I'm doing all my research, and I give premium subscribers a look at how I'm building the market-beating asymmetric portfolio. The other thing I want to talk about today, I'm going to be using Fiscal AI throughout this video. And starting today, they have their biggest sale of the year, 30% off. So if you've been eyeing Fiscal AI for a while, now is the time to become a subscriber. If you go to fiscal.ai/ASYM, that's where you're going to get that 30% off deal. They have really aggregated everything in finance, everything you need to know. Look at this company statistics. So every sort of statistic you need, all of financials. We're going to get to a whole bunch of these, but you can pull in everything from income statement, balance sheets, and KPIs. This is really the differentiator. Look at all these KPIs they have for Uber. So you can look up monthly active customers on the platform, total trips, take rate, and then you can build great looking charts as well. So whether you're an individual investor or you're in finance making a presentation for clients, this is going to be the best tool for making great visuals. And where they really made some leaps over the past year, all of the filings that you need, all of the ownership, so insider ownerships and trades, really easy to find. And then investor relations and transcripts. Everything is all in one place. So you want to look at the Q3 transcript or the report or the slides, really easy to pull all these things up in real time, go into full screen mode. You can see everything all in one place. That's fiscal.ai/ASYM. Like I said, 30% off. This deal is only going on for a few days. So if you've been eyeing Fiscal AI, now is the time to get it. But let's go into Uber and let's start with the financials and the valuation, because this is a company that is the obvious leader in ride sharing today. But the valuation is actually pretty compelling. If you I look at enterprise value to sales for these companies that continue to grow, 3.5. One of the reasons that Lyft was one of my top stocks coming into 2025 was very similar business to Uber, but they were significantly cheaper. That gap has closed a little bit. That's why I'm going with Uber if I had to pick one stock today. But really, what I've done in the asymmetric portfolio is build a basket of these two companies. But this is not a terrible valuation. This enterprise value to sales number right here, price to free cash flow, 20. That's a pretty good value for a company that over the past 3 years has grown revenue at about 20% on a compound annual basis. Look at the forward numbers, price to earnings multiples, 25. Price to free cash flow, about 17. So pretty good price if Uber's business is going to continue to grow. So let's look at what that momentum is. Now, the long-term story for Uber is just steady growth. This is actually coming out of the pandemic. I didn't want to go too far back, but you can see the data goes back all the way to 2016. But I didn't want to go too far back because there was some outliers during 2020 and 2021. We can see over the past couple of years, this growth rate just keeps compounding. Let's throw the growth rate in here. And you can see the growth rate over the past year, 18%. That's up from a little over a year ago when it was 14%. So growth is actually accelerating a little bit. But if you're able to compound your revenue at somewhere in those high teens into 20% range, that's how you get asymmetric returns long-term, especially if you're paying a pretty fair price, which I think you are for Uber today. But look at these margins as well. Gross profit margin, about 40%. Now remember, Uber does not take the full revenue when you take a ride with them. So if you pay $10 for a ride, Uber is going to take about $2 to $3 of that. That's going to be their revenue. That $10 number is going to be their bookings. I'll go through some of these details in just a second. But that's the way that their accounting works. And then you can see operating margins has improved really rapidly. This is really since Dara came in as CEO, has gone from negative operating margins and then consistently improved those to about 8-9% right now. I don't think those are going to go particularly higher, but we'll see how the business changes as they get into autonomy. I'll talk about that in just a second. Here you can see the growth that we have in each of their segments. Mobility is in blue, delivery is in orange, and then purple is their freight segment. Freight pretty flat, but it's still a pretty big business, about $5 billion worth of revenue. We can see here compound annual growth rate for mobility. This is now since December 2022, so taking out most of the pandemic impact, 29% compound annual growth rate. So you have two things going on there. You have more people using the platform, and you have the people using the platform using it more regularly. Delivery up 15%. This is where they've actually lost a little bit of market share to DoorDash. DoorDash, again, another company that I've considered, but it's actually more expensive than Uber is today. So I like the fact that you have both of these things. They're actually moving to more of a unified app. You have Uber One, so they're kind of pulling that value together into a subscription model. I think that's what makes this ultimately a little bit stickier. But the story here is that this is an aggregator of demand. The way to find value in technology companies today is think about what are people choosing to interact with. When you open your phone and you're looking for a ride or you're looking for a delivery of something, what's the first thing that you click on? Likely that place is Uber. From there, you have to look at, well, how does the economics of the business look? And this is a quarterly look at their take rate and also their free cash flow. So the real change over the past couple of years has been that Uber has increased their take rate. So that $10 I talked about earlier, look at this. They've gone from a take rate in the teens, 15, 18%. Now we're looking at 27% or so. So out of a $10 bill, $2.70 becomes revenue ultimately for Uber. The rest is shared with the driver. That increase in take rate has also increased their margins and their free cash flow. So on a quarterly free cash flow basis, you can see that generating over $2 billion in free cash flow quarterly. That gives you flexibility to invest in the business, to invest in partners. That's something they're doing in autonomous driving. So they want as many suppliers as they can possibly have in autonomous driving because they want to be that central point of demand. So they're helping fund companies like Lucid. They want to make sure that there's lots and lots of supply, and spending a few $1 billion here and there sounds like a lot of money, but that's going to give them a real point of advantage once more autonomous vehicles get on the road. But this is really how the economics work. Their increased take rate has driven higher free cash flow for the business. This is a story that we've seen across all of these ride-sharing companies. This is the other one that I think is really key. In blue, what you have is the monthly active platform customers. So the number of customers that Uber has on the platform, that continues to grow, compound annual growth rate in the teens. But 189 million people use Uber on a monthly basis. That means that they are really reaching scale with this platform. And that's exactly what you want to see, because once you reach scale, once you have both supply and demand on the platform, it's really difficult for anybody else to break in. But how much are each of these riders actually using Uber? That is growing as well, not growing quite as fast. Growth is about 5% on a compound annual basis, but going from about 5 rides to now 6 rides per month. That's something that they want to see increase over time. And I think autonomy will help with that, but the trends are absolutely in the right direction for Uber. So we have pretty good valuation. You have the right operating metrics. Now let's get to what the 10x opportunity is. And this is what asymmetric investing is all about, is paying a fair price for a company and then having upside that the market doesn't really realize is there yet. And I think that is in autonomy. Before I get to some of their updates in the most recent quarter, I do want to go back to February when they gave a presentation and actually detailed what their long-term strategy is in autonomy, because I think this really clearly states exactly where they're going and where the big opportunity is. So if you look at the history of ride sharing, you start with Uber XL, then you go to Uber Comfort. These are relatively expensive per mile. And the market size, the total value of the market, is relatively small. So when I first started using Uber, it was just black cars. A lot of times you would even get something like an Escalade picking you up. And it might cost $20, $25 to go a couple of miles. Now, the alternative was a taxi. You had no idea when they were going to arrive. So at that point in time, it was worth it. Now we've really moved down the curve now where you can get a ride almost anywhere, but you're going to get it in kind of a regular vehicle. So Uber X Share, for example. But the addressable market gets bigger as the cost per mile goes down. So right now we're paying somewhere between $2 and $3 per mile for an Uber. If that gets down to the point where you're talking about $1 per mile, and this is a target that a lot of autonomous vehicle companies have set, is $1 per mile. That's where they could make, that's where I think you 10x the size of the market. So basically the market is exponentially bigger as the cost per mile comes down. That's the way to think about the opportunity. Now, strategically, what is Uber doing? Uber wants to partner with as many autonomous vehicle companies as possible. Why is that? They want to make sure that no autonomous vehicle company has power in the market. If you think about why Uber is profitable, they're able to scale their business, they are the one point of contact for riders, for their customers. So they're aggregating demand. That's the concept to understand here. Any single one of their suppliers does not really have any power over Uber. So if one driver decides to quit, that's fine. There's another driver who will basically fill their slot in any given market. If we get to the point where autonomous vehicles are only coming from one company, that takes away the power that Uber has in the market. Now, the point of power is the company that's making that vehicle or that technology. So they want to have as many technology companies. Waymo is obviously slightly more vertically integrated, but they're partnering with them. WeRide, Pony, AV Ride, all these companies, Nuro, are actually doing technology, and then they're trying to sell that technology to partners. So Nuro, for example, is working with Lucid. They got funding from Uber because Uber wants to have more of these suppliers in the market. That's the way to think about this. That's why you see all these other players here. They want to have as many companies. Mobileye is one that I'm also invested in. They're working with Volkswagen. So they're going to be, I believe it's on Uber starting next year, potentially 1,000 vehicles or more in the LA area. But enabling this is really what's going to enable a 10x opportunity for them. So enabling regulation, scaling ground operations. This is something that they're working on both themselves and with partners. And I'm not going to dig into this too much here, but I think one of the things that a lot of people misunderstand about autonomous vehicles and this ride-sharing business in general is that you need to match supply with demand. So right now, this is when people are actually riding between 6 a.m. and 6 p.m. typically. And then during the middle of the night, not a lot of usage for vehicles. Now, that's not a problem if you're Uber because all those drivers then just aren't working. They aren't on the platform. But if you have an autonomous vehicle, you might as well have it working 24 hours a day. What people aren't really thinking about is there will be demand. If we get to the point where it's $1 per mile, $1.50 per mile, and there's no driver involved, there are deliveries that need to happen at night. There are retailers that would love to deliver things to you and have them sitting at your door at 6 a.m. There are businesses like restaurants who need to get deliveries between 12 a.m. and 6 a.m. So there's a business model to fill this here. And one of the things that disruptive companies do is they enable other people to create business models. And I think that's an underappreciated opportunity for Uber is if they're bringing this supply to market, where they say, you know what, we have demand between 6 a.m. and 6 p.m. for rides or for deliveries, but then we have an opportunity for somebody who wants to fill this gap between 6 p.m. and 6 a.m. That will find a market. So a lot of people think that this is wasted time, wasted productivity, wasted capital for a company like Uber. I think it's actually opportunity that will ultimately become a point of growth for Uber. So something to think about is this business model is not fully played out yet. So now if we go to the Q3 presentation, this is where they talked about a recent partnership with NVIDIA. So NVIDIA, another company that's building a platform, they're not going to be an OEM. They're not going to be the full technology supplier. They're going to be the brains of autonomous driving, the supercomputer, and the unified architecture for OEMs to build on. But again, you're bringing multiple OEMs to the market. So that's exactly what you want to see for Uber. NVIDIA and Uber both have the same incentives. That's why they're working to build a technology ecosystem together. And if you have that technology ecosystem, why aren't you delivering groceries? Why aren't you delivering electronics, pet food, home, beauty? All of these things are bigger and bigger opportunities for Uber as autonomous vehicles come to market. That's where you really get the 10x opportunity. So you look at Uber stock, and I think it's trading for a fair valuation. Now, I would love to pay 15 times earnings instead of 25 times forward earnings. But right now, I think we're at a fair valuation. This is not one of the more expensive companies in the market. We're growing well into double digits, so the core business is really strong. And the opportunity in the future is even bigger because autonomous vehicles are coming. They're coming to more and more cities around the US and around the world. I think 5 years from now even. Remember, it took only 10 years or so from Uber to go from being an app that was created to something that was ubiquitous everywhere. It was very strange to get into an Uber early in Uber's development. But then 10 years later, it was commonplace. I think we're going to go through the same transition with autonomous vehicles. It's strange to see an autonomous vehicle in most cities in the US and around the world today. It's not going to be strange 5 or 10 years from now. That's going to open up more doors, more opportunities. There's going to be more supply for rides, for deliveries, for all of the things that Uber can bring to market. And they are going to be the point of integration, the point of demand. That's where you get an exponential growth opportunity. I think that will ultimately translate to both higher revenue and higher cash flow for the company. So Uber, if I have to pick one stock today, Uber is going to be it. Lyft does get an honorable mention because it is a cheaper stock, but it just simply doesn't have the scale. So if you're looking from a risk reward perspective, Lyft is going to be a little bit higher on that risk profile. So let me know what you think about Uber in the comments section below. And I want to remind you again, Fiscal AI, 30% off right now. If you've been looking at that product, check that out because now is the time to buy. You only have a few days. This sale is going to be done at the end of the weekend, but go to fiscal.ai/ASYM to get that 30% off right now. Thanks for watching, everybody. We'll see you here next time.